What's up, guys? It's AJ here, and in this video I'm going to be sharing the top 8 individual stock positions in my personal portfolio. Now, a quick word on what I'm going to be going over in this video. This is just individual stocks. I own a number of ETFs, and I also own a number of term deposits, but I won't be covering those in this video. Why? Well, for the most part, we all know what the deal is with ETFs. They're highly diversified, they have very low fees, and they track an index. Most people who are pretty experienced with investing are aware of that, and there's not a whole lot I can add here. Second, with term deposits, they're all pretty much interchangeable, with the exception being term to maturity and yield. So the individual stocks are the most interesting part of my portfolio, and in this video, I will do a quick review of all 8 individual stocks that I hold currently. First up is Alphabet, otherwise known as Google. This company is relatively inexpensive by the standards of big tech these days, trading at 27 times earnings. Now, you might laugh at the idea that 27 times earnings is cheap, and it's certainly not cheap compared to the markets as a whole. However, it is cheap compared to Google's peer group. We've got Apple, Microsoft, and Nvidia all well above 30 times earnings. On a sector relative basis, then Google stock is fairly cheap. Second, Google has a lot of moats. Google search has a greater than 85% market share in search. Bing launched a chatbot recently, which led many people to think that Google was going to lose its competitive advantage in search. But in fact, Bing's market share peaked in October 2022. It's actually lost share to Google in that long period of time. So Google search's moat is holding up very well despite the alleged threat from chatbots. Second, there's YouTube, which has pretty much got long-form internet video on lock. There's some competition in short-form video from the likes of TikTok and Instagram Reels, but nobody's really going head-to-head with YouTube in long-form video. And finally, we have the Google Drive suite of products, whose only major competitor is Microsoft Office, and which has over 1 billion users. And then, of course, there is Android, which is in a smartphone operating system duopoly with Apple, and is a major revenue driver for the company. There aren't that many competitors in any of these spaces, and I'm not even getting into everything that Google does, so this is a company with an excellent competitive position. Next up, we have Bank of America, which is a stock that I started buying in 2022, and I really jumped at the opportunity to buy it in 2023 during the regional banking crisis when it went as low as 26. When Bank of America was at 26, its PE ratio was very close to the PE ratio it was at when Warren Buffett bought it in 2011. It was about a little under 8 times earnings. I think I calculated that if it had fallen to 24, you would have been able to buy it actually at the same trailing earnings multiple that Buffett bought at all those years ago. It never really did get that low, but I bought the dip in it, and I have seen good results since I did so. Bank of America has better than average risk management for a bank. It always keeps lots of liquidity on its books. It was criticized during the regional banking crisis for having too many unrealized losses on its held-to-maturity securities. However, you need to realize that even after you write down the value of its held-to-maturity securities to fair value, it still has over 50% of its deposits covered with liquid assets, and that's very good risk management. Third, we have TD Bank, another bank stock. This one is a relatively high yielder compared to Bank of America, with a yield pushing 5% right now. If you're American, you'll generally pay a 15% withholding tax on TD Bank stock. However, if you hold it in a 401k, you're exempt. TD Bank has grown much more than average for a bank over the last couple decades. It attempted to increase its U.S. presence this year, U.S. being the main growth driver for the company, with some success. It succeeded in buying out the investment bank Cowen, but it had its deal to buy the regional bank First Horizon shut down by the regulators. I personally consider the cancellation of the First Horizon deal a positive. TD was offering a really large sum of money for that company, valuing it initially at 15 times earnings, and later, after First Horizon's earnings grew, at 13.5 times earnings. The valuation came down a little bit, and TD said that because of $660 million in cost synergies it was going to realize, it would take the deal PE ratio down to 9.8. But by the time the regional banking crisis got underway, a lot of these regional banks were trading at 5 or 6 times earnings, and it just looked like TD was offering a little too much for First Horizon. The good news is that TD is still free to pursue expansion in the US by opening more branches, and the stock is relatively cheap today, trading at well less than 10 times earnings. Fourth, we have Apple. This is one of the most widely covered stocks in the world. There's a good chance that you know at least something about it. It's a mode stock like Google. It has the world's first or second strongest brand, depending on which market research company you ask. And it has an ecosystem strategy, which means that the software on all of the different devices it offers syncs with the software on other devices. So the minute you buy an Apple product and you log into iCloud, your data from another Apple product syncs over to it, and it creates these products that work seamlessly with one another, incentivizing customers to buy more than just one product. For this reason, Apple has among the best levels of revenue per customer in the industry. Apple stock is very, very expensive right now, and I probably wouldn't go buying any new positions in it today. But since I acquired my shares at a much lower price than the stock trades for today, I'm just going to sit tight for the time being. Fifth, Alibaba. Alibaba is the undisputed king of Chinese e-commerce. It has the greatest amount of profit of any Chinese e-commerce company and is second in sales after JD.com. Alibaba got really cheap in 2021 when it suffered a regulatory crackdown that banned it from using various anti-competitive practices such as its choose one of two policy, forced it to share links with Tencent, and accept Tencent's WePay app for payments. These were setbacks, but Alibaba stock got so cheap that it was almost ridiculous, at one point trading for $60 per share. I actually bought Alibaba at that level. I had been averaging down for a while, and that buy worked out really well for me. And I think that Alibaba continues to have some potential from today's levels. There hasn't been much growth in the domestic Chinese business lately, but the international growth story is strong as ever, with Alibaba's international segment growing its revenue at 29% year over year in the most recent quarter. 6. PDD Holdings. If you're in North America, then you know this as the company that owns Temu, that fast-growing shopping app that everybody seems to be using lately. PDD Holdings is kind of like a miniature version of Alibaba. It doesn't have anything comparable to Alibaba.com or Alibaba Cloud, but its Temu app is very similar to AliExpress, only it's reputed to have much faster shipping times. With any of these Chinese apps, you're not going to get the speedy delivery you'll get with Amazon, but Temu does have a speed advantage over AliExpress, which has helped it, along with a massive advertising campaign, to grow very rapidly in the United States. In its most recent quarter, PDD Holdings' revenue growth was at about 48% and its earnings growth was over 100%. Despite that, this stock trades at a mere 18 times earnings. This certainly looks like an undervalued opportunity, and if the revenue keeps growing at the rate it has been, it will prove to have been a good buy at today's prices. 7th, we have Taiwan Semiconductor Manufacturing. This company manufactures 59% of the world's computer chips. It's a massive, massive player in the semiconductor industry. Charlie Munger has called it the strongest player in the semiconductor industry. It's the main supplier to NVIDIA, or manufacturer I should say, which means that if NVIDIA does pull off the 64% revenue growth that it's expecting in its upcoming quarter, then TSM has a very good chance of beating expectations in its next earnings release. Despite this, the stock is relatively moderately valued for a technology stock, trading at less than 20 times earnings. Overall, this is a stock that has performed well for me since I bought it, and I continue to expect good things. Last but not least, we have Berkshire Hathaway. I bought this one a little under $300, and it's worked out for me pretty well since then. Berkshire Hathaway is mainly a bet on management skill. It's run by Charlie Munger and Warren Buffett, two of the smartest people in the finance industry, and it has a whole bunch of other good people working underneath them, such as Ajit Jain in insurance, and Ted and Todd in investment management. This company, really more than any other, is a bet on the management because it has so many moving pieces that a person couldn't expect to reasonably get a complete understanding of the business. It is, however, run by very smart people, and sometimes it can be wise to bet on that. So there you have it, the 8 individual stock positions in my portfolio, ranked from most heavily weighted to least heavily weighted. Feel free to let me know what you think. Leave a comment down in the box below. Leave a like. If you own any of these stocks, let me know why you hold them. If you own any other stocks that compete with the stocks that I own, let me know why you prefer yours. And in general, have fun in the comments section and happy saving.